The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. These are your headlines. The Fed Chair Jerome Powell hailing the central bank's fight against inflation, but echoing his counterpart at the ECB in stressing the need for more data before any rate cuts.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy.
Have you noticed markets don't seem to worry about rate cuts anymore? Yes, the S&P 500 has now closed above the 5,500 points level for the first time, notching its 32nd record high this year, as investors take heart from Powell's upbeat comments.
Tesla shares accelerated, driven by a second quarter delivery beat, even as the total number falls on the year, with BYD looming large in the rearview mirror. French parties forge a Republican front as they look to prevent a far-right majority in Sunday's second-round election.
We need to prevent the Rassemblement National from achieving an absolute majority at the National Assembly, because it would be, and I say this from the bottom of my gut, it would be terrible for the country and the French. It would be catastrophic for jobs, for purchasing power, catastrophic for our economy and our values.
And it's the final day of campaigning as the UK heads to the polls then tomorrow, with Prime Minister Rishi Sunak warning of a Labour supermajority, as a new poll predicts that his party could have its worst showing ever.
Morning. How are you?
Morning, very well, thank you.
How long can the same trade of the year last? The trade where people get so excited about technology stocks and they don't worry so much about what the Fed is doing. And it's like the sweeties have been delayed on one front. You can't have your lower interest rates. You can't have your lower cost of borrowing, but you can have AI. And it's the same trade that we had on January 1st.
A few stocks got tossed out along the way, though, namely European names, because they have been tracking okay, but left aside now as we've got election risk all around with the UK and France. No.
Yeah, you're absolutely right, because the election risk in the States is clear and present for many people who are market historians, no matter who's the president, because of the fiscal position. And there are ramifications for treasuries, and there are ramifications for the stock market. But that's almost like, that's not on the agenda at the moment. Mostly it's kind of central bank and the data versus AI and technology. Whereas in Europe at the moment, it's 3D, but actually you can take that back down to 2D because we haven't got the same technological exposure. So it is technology and interest rates and political risk, but we don't have the technology bulwark that the US has.
Could it be a tipping point, though, as we talk about this extreme divergence in US markets, where eventually investors start looking beyond a handful of stocks?
Yes.
I mean, at least Tesla got in there yesterday in terms of the Magnificent Seven.
Rally.
Well, it's been Magnificent Seven at minus one or two stocks. Number one, of course, being minus Tesla, so back in the game yesterday. But I think this divergence with the rest of the S&P 500 on the cusp of earnings season, but also small cap stocks that have been left out, do we start to see some sort of tipping point for investors?
You mean broadening, diffusion, a spreading of the love for the tech names? We keep having lots of guests on this show saying that's going to happen. But when I saw that Tesla move, brilliant, thank you. Who put that board up? Because you just read my mind again. That's very scary. $231 for Tesla. This is a stock that was like, what was it, 170 a couple of months ago? I mean, it was pummeled, and before his vote to move down to Texas, and before he got his $56 billion, and before there's a lot of problems at Tesla, but it's just had the most almighty rally off its lows of the year. Extraordinary. But as we say, the Fed Chair, Jerome Powell, still holding. He has hailed the progress, though, made by the central bank in its inflation fight. He's stressed he needs more confidence before cutting rates. Again, we used to play a game, didn't we? The old Joaquin Phoenix. Have we learned anything new? Sarah's the most brilliant journalist. I love working with Sarah. But did she get anything new out of him? I don't know. Powell acknowledged the Fed is walking a fine line between cutting too early and too late, saying it risks undoing all the good work by moving too soon. Well, speaking to our very own Sarah Eisen, a CNBC moderated panel in Sintra, Mr. Powell said he wanted to see continued disinflation before any rate cuts.
We've made quite a bit of progress in bringing inflation back down to our target. While the labor market has remained strong and growth has continued, we want that process to continue. I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy.
Inflation across the Eurozone eased to 2.5% in June, in line with expectations and down from May's print. But core inflation stayed at 2.9%, missing forecasts. ECB President Christine Lagarde has dismissed suggestions that Taylor Swift's Eras tour is keeping inflation high across the Eurozone, saying that other musical acts have come to Europe as well. Services inflation remains sticky in June's print, coming in at 4.1%, coinciding with the European leg of Swift's tour, triggering talk of potential Swiftflation. And Lagarde said more information is needed to ensure second-round effects are avoided.
So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window and services are also going to be on a declining path as well.
Well, who thought they would be economic terms, Swiftflation and Swiftonomics? I mean, I never thought I'd be saying that live on air, but that seems to be a feature that came up in the conversation yesterday. And I think to Christine Lagarde's point, it is about the behavioural patterns that you're seeing from some consumers. But let's not just focus in on Europe, because you're seeing the same patterns elsewhere. The people are cutting back in some areas on some goods, but are still willing to spend on certain services, namely that experience around concerts, but also still on travel. And this is the behaviour that central banks cannot grapple with. I think we heard it from Jay Powell yesterday. Progress and confidence. They've seen some progress. It's clearly not enough. They want more confidence before cutting rates. Although some economists think that now is the time and the signals are ripe for a rate cut in the near future, because of what you're seeing on the PCE getting back slightly towards that 2% mark.
Yes, but they're very worried about a whole host of things. For a start, I applaud any economist or any business news presenter who's trying to make the Swifty story about economics, because it's just palpable nonsense. It really is palpable nonsense that one factor can affect broader inflation trends over a longer term period. It's inconsequential in the bigger debate. But I applaud people for trying to get it in the story. Services inflation, shelter inflation, wage inflation, there are some very real problems over a longer term period as well. I had a conversation anecdotally with Charlotte just now, and we were talking about our insurer. We like our insurer. We don't have a problem with our insurer. I know the senior leadership at my insurer. But it didn't help me not get a 30% increase in my insurance premium. And then I went elsewhere. Of course I did. I went on comparison sites. I rang up one or two others. And it was even worse. So the inflation in services is real and long-lasting as well. And the insurers are making hay because they can. The fact of the matter is, wage inflation could also be as painful as well. Did any of you bother looking at the JOLTS yesterday? I hope you did, because the JOLTS showed something. It showed that actually things aren't getting worse on the labour market. You can play with decimals if you like. For instance, the average in 2019 was something in the region of, 1.19 vacancies for every person who's unemployed. And now it's gone to 1.22 in May. We're splitting decimals here. In fact, actually, the number of jobs available came off its recent lows in the most recent data and is actually more. We saw a bigger figure, 8.14 million job openings, unexpectedly rising in May. That is the kind of data that could actually affect the broader inflation trends and affect when interest rates are cut.
Well, let me just pick up on the timing aspect, because Jay Powell was asked about that in September in particular. And the message was that I'm not going to be landing on any specific dates here today. It reminds me a lot of the conversation I was having with the ECB Governing Council earlier this year, when there was a real discussion as to whether there would be a follow-up rate cuts in July if they moved in June. And really most of the Governing Council hesitant to pre-commit. And that does tell me that unless you get really, really big moves in the data to the downside, then you're not necessarily going to get the move in the month that the markets had hoped they would see the cut. Yeah. So I think the lack of pre-commitment might be an issue for markets. The other point I just want to bring up, Richard Bernstein, writing in the FT from Richard Bernstein Advisors out of the States, talking about the highly speculative investments out there and saying, look, this suggests that despite the Fed's higher for longer story, that they haven't managed to drain the system of excess liquidity, which means this could still be a problem for asset bubbles and misallocation of resources to fairly unproductive parts of the economy. So as we talk about the long term, you would expect that given tighter rates, that we would be getting past some of that excess. Simply not the case.
Our very own Taylor Swift, more of a Nena really, 99 Ballons. It's a Luftballons, isn't it? Yes. That's on your own European tour, Annetta. Where are you? You've landed in Sintra for your latest concert.
Yes, exactly. So let me run you through what happens here on the ground. Essentially, that's what you have already talked about. They talk about the last mile of inflation fighting. It's not so easy, given that we have these wage data, and wages are backwards looking factor, one has to say, because, for example, wage round negotiations take place every 3 years for certain industries. So they do catch up for the last 3 years, what we see now. The big question is what we are going to get ahead. So whether there's enough momentum to actually pass through or to manage to get high wage negotiations as well in the future. And that remains to be seen, because at the same time the economy is weakening. But the labor market, as you're pointing out, is going quite strong, and that is because of the scarcity of labor, and that's our demography. So I guess we also need to talk, and I know you don't like this topic, to talk about digitalization and AI playing in that mix, because in the future there might be actually less labor needed for the same productivity. And that is what the ECB and central banker here are discussing as well. So it's very tricky to actually think about what factors in the end will determine how inflation will play out. But one thing is clear, that right now service inflation is still far too high. And of course the jury is out how many rate cuts we are going to get this year. I think the market has trimmed down expectation tremendously, and now still expectation run between 1 and 2 potential rate cuts. And that is what the central bank governor of Belgium, and who is of course also a governing council member of the ECB, Pierre Wunsch, told me yesterday here on the ground in Sintra. Take a listen.
We are data dependent, so my easy answer would say we're going to look at the data. But if you push me a little bit, the way I'm looking at it, we know, I mean, our forecast inflation will be stable and moving around 2.5% for a number of months. And I see room for cutting rates to 3.5 in this environment if our projection materializes. After that, we can go below 3.5, but I would need to see more clearly probably in the momentum of some of the data, be it wage or inflation or service inflation, that we are clearly moving from 2.5 in the direction of 2. So give or take 25 basis points, but inflation has been going down, and because we were at 4%, real rates were going up, so that created some room for removing some restriction. But at some point we'll need, beyond the projection, I think, really data moving below 2.5% to 2% before doing more. So yes, I'm quite comfortable going to 3.5 if we are, say, moving in the direction of the projection, and I would say.
How many others do you have in your camp in the Governing Council?
I think there is a very broad consensus that things are moving in the right direction, which I completely agree with. We didn't have unanimity, but a very broad majority to cut rates in June, and I was convinced that we should do that. And then for the rest, I think it's really a question of how we interpret the data and how comfortable we are in terms of pace. So I don't see it as really a matter of being in one camp or another. I think we're broadly speaking in the same camp.
But still, it seems that some are rather erring on the side of caution and wanting to stick with an elevated restrictive level of interest rates rather than to progressively cut, if not aggressively. So how would you describe that opinion picture inside the Governing Council?
I would consider myself as in the camp of those that want to be cautious. But I mean, let's take a step back. I mean, in March or April, the markets were, pricing more than 100 basis points of cuts, and the data was going in the right direction. We had a number of good readings, and we decided not to cut. And retrospectively, I think it was a good call. I mean, we decided to be patient and to wait for June. And then in June, we had two numbers going in the wrong direction, so it made the communication a bit difficult. But that's why we really took some distance.
Another element, of course, here on the ground in Sintra is the political agenda in Europe and also, of course, the election in France, but also what happens with policy making in Europe. And here we need to talk about fiscal dominance. I guess it's very interesting to read the fine print, especially, for example, when it comes to the budget negotiation in some countries. They are the expectations of lower interest rates is something they are also taking into account, because of course that also means lower interest payments on that huge debt pile the governments are sitting on. We currently, I think, have 4 or 5 deficit procedures in Europe. One of them is the case of France. And that, of course, is a major issue as well for the ECB going forward, because debt sustainability is not only an issue in the United States and in emerging markets, but it's also an issue in some countries here in the euro area.
Annetta, terrific coverage. Thank you very much for bringing that to us. Ahead on the show, Tesla shares surge as deliveries fall less than expected in the second quarter. We'll break down those numbers for you. Arabile is live from the streets of London as the final day of campaigning gets underway before the UK heads to the polls tomorrow. And we'll continue the conversation out of Sintra, where Annetta will be speaking to Goldman Sachs chief economist Jan Hatzius. You can catch that first on CNBC interview at 9 o'clock CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
The best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters and global business leaders on CNBC.com.
Look at the market stateside, and you can see very strong ranges again on the S&P 500 and the Nasdaq. The rally above 5,500 points for the S&P 500 as it inked a fresh record close. Another fresh peak on the Nasdaq as well. The market 18,028. Big moving names. It was Tesla this time round. That was the big one moving the market forward. Curiously, Nvidia underperforming, and actually the drag on the market indices despite these record levels. Across to the Dow, still a whisker off its all-time peak, but scooping up another 0.4%. So a day positive is what we could see. Let's push on to what we're seeing elsewhere on the markets and what we saw for the Treasury market. Fascinating that the market has honed in on some of these yields since the debate and the showing by President Biden, concern around what a Trump presidency could mean in terms of spending levels. So we've seen an escalation in some of these yields, roughly about 10 basis points into the debate. So now 4.44 at the long end. In terms of what we're seeing on the markets elsewhere, let's just push on to some of the trades on foreign exchange markets. Yen has weakened, and we're seeing it not just versus the dollar, but versus the euro and also against sterling. So sterling yen, the highest since 2008, euro yen trading at a record, and when it comes to dollar yen, the highest level since 1986, as we see that further weakening of the Japanese currency. Euro dollar this morning, don't forget we're talking about election risk, 107.37, so we're on the back foot as we count down to the second round of the French election. Sterling, we're right on the cusp of UK election, and you can see just a little bit of softening up morning session. Greenback has it. Let's push on to what we've got across on the Asian markets. Japanese stocks rallying 1.25%. We're 9/10 up on Hong Kong. The Shanghai market trading weaker. We've given back territory. We're down about 4/10 plus. The Australian market trading higher by about 0.25%. Steve.
Right, China's Caixin, you've just done that, haven't you? So let's get to where my prompt is. Okay, BYD is closing the gap on Tesla, having ceded the title of world's top EV vendor in the first 3 months of the year. The Chinese EV maker sold 426,000 purely electric cars in the second quarter, up 42% on the quarter. That is 18,000 fewer than Tesla delivered, down from a gap of 86,000 in Q1. Total sales hit a new high of almost 1 million as the firm cut prices of most models.
Tesla deliveries slowed for the second consecutive quarter as the world's largest EV maker battled slowing demand and competition from Chinese competitors. Deliveries fell 4.8% on the year, but rose 15% on the previous quarter to just shy of 444,000, narrowly beating expectations. It's a sign of going forward and back, I think, when it comes to some of these deliveries between Tesla and BYD, because at one point it's BYD, the next point it seems to be Tesla in terms of who's the top producing EV maker. BYD beat on total production last year. Tesla had the top spot this first quarter. BYD might be bouncing back as well. So I think it is telling you about how competitive the space is around these two major players, but it doesn't escape the broader trend that there has been this slowdown in EV adoption and makes it very difficult for these players. What do they do next? Tesla, its lineup is quite old now in terms of the vehicles it's had out in the marketplace. I think one quote was roughly about 5 years on one of the models, when typically you start to refresh models by that time frame. So does Tesla throw more money in a very competitive market where returns are being difficult to chase by upgrading that model and trying to bring something fresher to market?
It's the most extraordinary stock. Since April, 22nd of April, it hit $138.80. $138.80. It just hit last night. Was it $231? $231.26. An enormous rally off the lows. Well, what are we talking? 50% rally off the lows and a bit of change as well. And the stock's gone from pretty expensive to extraordinarily expensive again, to 73 times forward. And it's done it with a backdrop of no growth. No growth. And it's done it because I think Musk has been placated with his $56 billion. And now the hope is that all these exciting new things he's working on will be done under a Tesla umbrella. As Wedbush, I think, pointed out, or one of the other, maybe it was Jeffries or something, pointed out, this has gone an ex-growth stock at the moment as well. So you've got vicious competitive situation. You've got enormous amount of cost cutting, which is not a great atmosphere as a backdrop to be bringing out new models, by the way, I hasten to add. You've got a situation where the Chinese rivals are extraordinarily fast up the rails in both Europe and indeed Asia as well. In the United States, I'm sure they're catching up as well. So you've got a huge problem. But the market's gone into, I'm not worried about the current situation. I'm betting on Musk in the future. And I think that's what they've done here as well, because the competitive situation is awful. And just as an anecdote, producer David and I, David pores over the ACEA data all the time on a regular basis. We just did a little search of second-hand electric vehicles. And I don't care what any of you say there who love electric vehicles. And I want to get one at some stage. It's just not fit for purpose for what I need at the moment, because I live in the countryside, etc. But the fact of the matter is, unbelievable discounts on second-hand Teslas and the rest of the sector.
Yeah, which provides some uncertainty for the customer, doesn't it? But I wanted to just come to the trading around the stock. I think it was just a very low bar. And don't forget, when you've had other major stocks in the Magnificent Seven basket going from strength to strength, this one was left out. Share price was down 16%. So I think the market has been looking at whether the numbers were good enough to lift it off the low base.
But it's already. But my point was, ahead of these numbers, it's already had a gigantic rally off the 139 base, 138.80. It's already rallied enormously back up to circa $200 as well. So the shorts are being squeezed on this one. There's 3.3% of the shareholding are shorts on this one as well. That is larger than your average shareholders. So they are getting killed at the moment on this.
Teething issues too, don't forget, production halts as well. So there's been a series of issues. One around the demand story, competition coming through fast, and the production halts, Elon Musk. I mean, I think there's been a host of issues. The market's been picking its way through each one of these, and yesterday was quite consequential when it comes to those quarterly sales. Let's push on to Apple. It will reportedly join OpenAI's board in an observer role later this year. That's according to Bloomberg. The role will be reportedly filled by Phil Schiller, the head of Apple's App Store. It puts the iPhone maker on a par with Microsoft, which took a similar role last year. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.